Hello, joining me today is highly respected investor Bill Ackman from Pershing Square Holdings. Now, his portfolio is heavily exposed to US consumer through names such as Burger King owner, restaurant brands, Chipotle and Lowe's. So, Bill, are you worried about potential recession hurting the US consumer, consumers starting to spend less, and of course this would feed through to lower earnings of some of these companies in your portfolio?
I would say the following, where we are in the restaurant space is kind of the highest value per dollar, right? Chipotle is an incredible meal at a very low cost for a family. And in a recessionary environment, historically people don't stop eating out, but they might adjust from the sit-down restaurant, with menus and a waitress, to a fast food environment or a place where they go pick up their own food at the counter. And actually the fast food, if you will, the quick service restaurants have generally done well in recessionary environments. And I think the overarching point that the value of a business, unless it's a highly levered, very economically sensitive company, is not particularly affected by the event of a recession, right? If you own the value of a stock, right, the value of an interest in a company is the present value of the cash that business generates over its life. And if it's a business that should exist forever, well, pick Hilton, for example, we can expect that in past history, there's been a recession every 7 or 8 years. Let's assume the future is the same, and there's a recession every 7 or 8 years going forward. That's kind of factored into the value of the enterprise. The only reason why a recession destroys value is you have a company that is highly levered, and then if revenues decline, their cash flow goes negative and they can't support their debt and they go bankrupt, right? But if you own a very well capitalized business, I don't think a recession has a meaningful impact. It might affect that year's revenues and cash flow, but that's just one line item in a long spreadsheet of cash flows that you discount, if you will, into the present. But the businesses we own, Universal Music being the largest one, and a good example, people are not going to, we think, cancel their Apple Music subscription because we're in a recession. It's the cheapest form of entertainment. It's 10 cents an hour or something like this. Compare that to a movie or a video game, you pay a lot more.
I mean, you sold a stake in Netflix this year after only owning it for 3 months. You sold your stake in Domino's. You only bought that last year. Aren't you a believer in long-term investment? Particularly with Netflix, obviously share price is up quite a bit since you sold it. So.
Yes, so we look for businesses we can own, so to speak, forever. Our favorite holding period is something that we never need to sell. Universal Music, I hope, is something we'll never need to sell. But we always reserve the right that if new information comes to light that causes us to reassess our original thinking, we're prepared to exit. And Netflix is really the traditional example of that. I mean, a business, what attracted us, stock was down from the middle 700s to high 300s on a subscriber miss that the company attributed to COVID, difficulty predicting kind of the COVID. Netflix was a huge beneficiary during COVID, and the thought was they got a little bit off trend. 3 months later, they came back and said, well, we're not sure it's actually COVID. We think that we have a much larger number of unpaying, i.e. people who share passwords than we thought, or than we at least disclosed previously. This is causing us to reassess our business model. We're going to go to an advertising model. And while we have enormous confidence in a management team that's done a fantastic job over many, many years, it's a completely new approach to their business. And I think for us, it made the future difficult to predict in terms of the future, what's going to happen. And we're a very concentrated investor. We put a large amount of capital in each commitment. We want these to be things that we can predict with a high degree of confidence over a long period of time. And Netflix became, if you will, unpredictable for us. So we sold it. And we sold it around $225 a share. No, $275 a share. Actually, I don't remember a precise exit price. It's trading above the price we exited, but that doesn't mean it wasn't the right decision to exit for us. An investor who owns 100 stocks is a place for Netflix. An investor who owns 9 or 10, in light of the uncertainty created by the changes in how they're going to approach their market, we felt it was not something that could fit into our portfolio. In general, we like to own things for the long term. On Domino's, we actually made a profitable investment over the course of the year. Our original holding period intention was not a year, but the world changed in a pretty dramatic way. One, it got a lot more difficult to get labor. a lot more difficult to find drivers, much higher interest rate environment. And the combination of those factors and the valuation that when we sold made it, in our view, just a less attractive opportunity. We'd rather deploy the cash elsewhere.
I mean, obviously the market has thrown up some big opportunities this year. Have you sort of been buying anything new recently?
So actually so we put our capital in two places. One, we launched one of the more aggressive buyback programs out there. We're buying in about 1.5 million shares, approaching about 0.75% of our shares outstanding every month. That's a pretty aggressive program. It's about 28% of the average shares outstanding. We think that's the easiest investment that we can make right now.